All right, let's dive right in. We're going to talk about the single biggest financial market on the entire planet. Seriously, it's this invisible force that quietly affects pretty much everything, from the price of your morning coffee to the health of the whole global economy. We are talking about the foreign exchange market, or as you'll usually hear it called, the FX market.
So, just to give you an idea of the scale we're dealing with, let's start with a number. It's a number that's kind of hard to even wrap your head around, honestly. $6 trillion. That's the amount of money we're talking about here.
So, what kind of market trades that much money every single day? Nope, it's not the stock market. Not even close. We are talking about the foreign exchange market, the FX market. It's the massive global marketplace where all the world's currencies get traded back and forth. Okay, so to really get a handle on this beast, we're going to break it down into 5 key pieces. First, we'll talk about why it's the world's biggest market. Then, how it's a market that never sleeps. We'll learn to speak the language of FX, look at trading now versus later, and finally, get into how the future is actually priced. Sound good? Let's jump in.
All right, Section 1, the world's biggest market. Let's get right into an introduction to FX. So what exactly is this massive, kind of invisible market we're talking about?
So here's the first thing you got to understand. Unlike, say, the New York Stock Exchange, there's no physical building you can point to and say, that's the FX market. It's not a centralized place. Instead, think of it as a giant global network. It's basically a web that connects all the major banks and currency dealers around the world. And in this world, the US dollar is king. It's the most traded currency by far. And here's a fun fact for you. The biggest hub for all this action, it's London. Yep, London handles a huge chunk of the world's daily FX trading.
Okay, Section 2, a market that never sleeps. So if it's not one physical place, how in the world does it work? Well, that brings us to one of its most famous features, the 24-hour trading day. Because this market is totally global, it just follows the sun around the world. It operates continuously through 4 major trading sessions. It's like a relay race. It kicks off in Sydney, then the baton gets passed to Tokyo, then over to London, and finally, it finishes the day in New York. So as one major center is closing down, another one is just waking up and opening for business. It creates this seamless, non-stop trading day all through the work week.
And check this out, this is where things get really interesting. For a few hours every day, these sessions actually overlap. You know, like when the traders in London are still at their desks finishing their day, and the traders in New York are just getting started with their morning coffee. Those overlap periods, that's when the market is at its absolute busiest. It's when you see the highest volume of trading, period. All right, Section 3, speaking the language of FX. Just like any specialized field, you gotta learn the lingo to understand what's going on. So let's break down how currency quotes actually work.
Okay, so the golden rule of FX is this. You never just buy a currency. You're always trading one currency for another. That's why you'll always see them quoted in pairs. Think Euro/USD, that's the euro versus the US dollar, or GBP/USD, the British pound versus the US dollar. It's always a dance between two. So every pair has 2 parts, and it's pretty straightforward. The first currency you see is called the base currency. Just think of it as being equal to 1. Simple, right? 1 unit. The second currency is the quote currency. Its job is to tell you how much of it you need to buy that 1 unit of the base. So for example, if you see Euro/USD at, say, 1.1650, that just means it costs you $1.16 to buy 1 single euro.
But here's the thing. You're almost never going to see just one price. A real live quote is going to look more like this. You'll see 2 numbers, separated by a slash. So what's going on here? Let's break down what these 2 different prices actually mean. It's actually pretty simple. You've got a price to buy and a price to sell. That first number, the lower one, is the bid price. That's the price the dealer will buy the base currency from you. So it's the price you get if you're selling 1 euro. The second number, the higher one, is the ask or offer price. That's what the dealer will sell the base currency to you for. So it's the price you have to pay if you want to buy 1 euro. And that tiny little difference between the two, that's called the spread. And that, my friends, is how the dealer makes their money on the transaction.
Okay, moving on to Section 4, trading now versus later. It's all about timing. See, not all foreign exchange trades happen right this second. There are really 2 main ways you can do it, through spot and forward transactions.
First, you've got a spot transaction. Think of this as a deal for right now.
You agree on the price immediately, but an interesting little detail is that the actual money doesn't change hands for 2 business days. It's just an industry standard. They call it T+2. Then you have the forward transaction. This is totally different. Here you agree on a deal today for an exchange that's going to happen sometime in the future. But, and this is the most important part, you lock in the exchange rate right now for that future transaction. All right, Section 5. Pricing the future. This leads to a really good question, right? If you're locking in a rate for the future, how is that rate decided? I mean, it's not just a random guess. There's actually a really powerful financial principle behind it all, and it's called the logic of interest rate parity. So here's the core idea behind this thing called interest rate parity. In a nutshell, the market is set up so you can't just make free, riskless money. You shouldn't be able to just convert your cash to another currency, stick it in a bank account there to earn a higher interest rate, and then convert it back later for a guaranteed profit. The forward exchange rate is literally calculated to cancel out that potential advantage. It keeps things balanced. Okay, so how does this actually work in the real world? Let's just walk through the logic together. Step 1, you start with today's exchange rate, the spot rate. Let's say it's 1.25. Step 2, you look at the interest rates in both countries for the same time period, like 3 months. Now, your first thought might be, hey, I'll just move my money to the country with the higher interest rate and make more money, right? Well, the market is way ahead of you. The forward exchange rate is specifically calculated to adjust for that difference in interest. It's designed so that, by the time you're ready to convert your money back, any extra interest you earned is wiped out by the less favorable exchange rate. It makes it a wash. It achieves, well, parity. And this table here really sums it all up nicely. It's a simple rule of thumb. If the interest rate in the base currency's country is lower than the quote currency's, it's going to trade at a premium for the future. That means the forward rate is higher than the spot rate. And if it's the other way around, if the base currency has a higher interest rate, it'll trade at a discount. The forward rate will be lower. It's all just a balancing act to keep the financial world in check. Okay, so let's do a super quick recap of the key takeaways here. The FX market, it's a monster, trading over $6 trillion a day. It's a 24-hour, decentralized global network. Remember, currencies are always traded in pairs. A quote always has 2 prices, the bid, which is your price to sell, and the ask, your price to buy. And finally, those future or forward rates, they're not just pulled out of thin air, they're determined by the difference in interest rates between 2 countries. And that brings us to one final thought to leave you with. Now that you get the connection between interest rates and future currency prices, think about this for a second. What happens when a country's central bank, like the Fed in the US, decides to change its interest rates? How does that single decision, made in one room, instantly ripple through this entire massive $6 trillion a day global market? When you start to unpack that, you really begin to see just how connected we all are through the invisible world of foreign exchange.